In this month's Economic Update, Kaplan Professional Education's Michael Pollock speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's monthly Economic Update. I'm Michael Pollock, and this month we're speaking to HSBC Chief Economist Paul Bloxham. Thanks for joining us today, Paul.
No problem.
Firstly, looking at Australia, Paul, business conditions and confidence look to be finally getting up ahead of steam. What do you attribute the improvement over the past couple of months to?
This is a big part of Australia's Great Rebalancing Act, which we've been talking about for a few years now, and that is at the end of Australia's mining boom. Mining investment peaked in 2012 and commodity prices peaked in 2011. Australia's needed to rebalance its growth towards the other sectors of the economy. The major drivers of that, in the first instance, was low interest rates, in terms of driving a pickup in the housing market, and more recently it's been that there's been a pickup in the services sectors. In particular, we've seen very strong growth in services exports, a pickup in tourism and education exports, in international enrolments in our education facilities. That rebalancing of growth from mining to the non-mining sectors, plus the pickup in the housing sector, has delivered a pickup in business conditions. And in fact, the most recent print shows us that business conditions are at their highest level since the global financial crisis. And if you look at a state level, you find that in New South Wales, business conditions are at their highest level in over 2 decades. So growth is shifting. It's shifting from a mining-led story towards the housing and the services sectors, and that's delivering a pickup, particularly in the southeastern states, which is driving the national economy to show business conditions at their best level since the global financial crisis. It's a pretty good story.
And how sustainable is that growth in the longer term?
We think this is the new driver of Australia's growth story. We think the services sectors are going to be the areas that are going to support Australia's growth going forward. A lot of this has to do with rising middle class incomes in Asia and shifting demand from China in particular. The Chinese are in the process of shifting their growth story from an investment-led story to a more consumer-driven story, and Australia is getting the support from that in the form of demand for services from Australia, tourism and education, business services. We think there might be some prospect for Australia to be a larger health provider as well, and so we do think this is the next growth driver for Australia.
What exactly did RBA Governor Glenn Stevens mean last week when he said that an appreciating exchange rate could complicate the adjustment underway in the economy?
Well, this is where the real challenge for the RBA comes from at the moment, and that is we think that growth is very much shifting from a resources-driven story to a services export story. But of course, those services exports are supported by the increased competitiveness from a lower currency. The Aussie dollar's fallen from a peak back in 2011 of 110 against the US dollar, and we've been around a low point of just under 70 cents. We're now back above 75 cents on the Aussie dollar. Of course, the Aussie dollar is really moving the wrong way at the moment to support that rebalancing of growth towards the services sectors. And that's what I think the Governor is referring to, that growth is becoming now much more driven by this services export story and therefore much more dependent on a competitive currency. This is the challenge the RBA will face, and we think they'll face it going forward as well, and that is in a world where inflation is low, global interest rates are at exceptionally low levels, some countries have got negative interest rates, it's hard for Australia to have higher interest rates without also getting a higher currency. And the higher currency, of course, may weigh on our growth story and may weigh on the pace of that rebalancing.
What's your overall outlook for the Australian economy for the remainder of the year then?
Well, we have in mind growth this year will run at about 2.6%. This is very similar to the pace of growth we saw last year, which was 2.5%, and indeed it will be our 4th year of below-trend growth in Australia. But that's still a pretty impressive performance when you think that we've come to the end of the largest mining investment boom in our history. Mining investment is falling very sharply. Commodity prices are down 60% since their peak in 2011, and the rest of the world is dealing with very sluggish conditions. Global trade is still very weak. China's growth is slowing. So that's still a reasonably impressive performance in the scheme of things. With growth below trend, though, and inflation still very low, it does leave the RBA with scope to provide more support for growth by cutting rates if it needs to sometime down the track.
Turning to the US, where do you stand on Fed Chair Janet Yellen's comment that there's continued slack in the US labour market due to subdued wage growth?
Well, the US economy has been on this long recovery since the global financial crisis. When you look at overall GDP over the past 8 years, that is since 2008, they've expanded by 10%, which is a decent performance but not particularly strong. Growth at the moment is running, we think, it'll be running at 2% this year, so that's still a fairly weak pace of growth for the US economy. It's been just enough to absorb the new entrants into the labour market and get the unemployment rate to fall, but because they've had such a long period of weak demand, we've also seen that, of course, the participation rate has been falling. So a lot of people left the labour force when the global financial crisis struck and just have not re-entered into the labour market. And that is weighing on wages growth. And that's what I think the Fed chair has been referring to, the fact that the labour market is tightening up, the unemployment rate has fallen back to an approximate full employment level, but there's still a lot of discouraged workers out there who have not re-entered the labour force, and that's continuing to put downward pressure on wages. This is leaving the Federal Reserve with inflation that's quite low, and this has been the reason why the Federal Reserve has been very slow to lift interest rates.
What do you see as the drivers of growth in the US economy throughout 2016?
We think the US economy is gradually recovering. It's a pretty sluggish recovery, as I've already described. We do think there'll be just enough momentum to see the Federal Reserve lift interest rates again this year. We think they'll be lifting them again in June and in December. So we do think that they are on that path to recovery, but it's a pretty modest path to recovery. We think the main thing that they've got to see yet is a stronger pickup in business investment. Business investment still seems quite weak across the world, actually. It's been quite weak across the developed world, and in the US that's a challenge as well.
Looking at China, would you anticipate any benefits of the Australia-China Free Trade Agreement to be seen this year, or is it still too early?
It's certainly the case that Australia's recent success, in our view, has been largely driven by its trading relationship with China. We've benefited a great deal. In the first 4 years after the global financial crisis, that was a lot to do with our exports of resources, and now more and more it's about exports of services and agricultural products as China's middle class incomes rise and their demand for those products increases as well. The free trade agreement helps to grease the wheels of this process. It helps to improve our trading relationship with China. It opens up those markets more, and we think it will continue to provide support, as it is for Australia's shift in terms of its export basket to China from a resources-driven story to a more services and agricultural product-driven story.
Which sectors of the Chinese economy do you think will outperform for the remainder of 2016?
The process that's going... The Chinese economy is in the process of rebalancing as well. They're shifting from what was an manufacturing export-led story and an investment-led growth story, as it had been in recent years, to a more services-driven economy. The middle-class incomes are rising and the consumer is driving more and more of growth. So we think that trend is going to continue. We think that Chinese demand for services is going to continue to pick up, and that's what we're seeing, that the services sector is becoming a larger share of China's overall GDP growth. Australia, of course, is in the process of trying to shift its economy to also benefit from that change in the Chinese economy.
Just touching on Japan, what is the likely impact on the global economy of the recent increase in the value of the yen against the US dollar?
Well, it's certainly a big challenge for the Japanese. The Japanese policymakers have been seeking to try and lift inflation. They've been seeking to try and re-inflate their economy. They've taken some extraordinary measures to do that. A very large quantitative easing package that's been underway for quite some time. And the most recent move has been a cut to negative interest rates in Japan to try and lift inflation. Unfortunately, it's actually led to a lift in the yen rather than a fall in the yen, which is working against that goal of getting inflation to target. And so we do think that the Bank of Japan is going to need to take further action. We think that further action may involve increasing its equity purchases to try to support the economy, but it's certainly a challenge to the Japanese economy that the yen has been appreciating. It's a challenge to their plans to try and get inflation back to target.
And finally to Europe, with the ECB announcing another round of QE, what will be the biggest challenges both internally and externally as it attempts to meet its inflation targets?
Europe's got some fairly enormous challenges still. I mean, the major one has been that demand has been weak, and the demand has been weaker than is needed to get inflation back to target. And of course, inflation has been persistently below target for a number of years now. And this has seen the ECB take a further step. In addition to having a quantitative easing program, they've now cut their policy rate further into negative territory as well to try to support growth and support enough demand to get inflation back to target. That process is still underway. We're still seeing how that works through the European economy, but along the way, of course, they've got the challenge of having high debt levels across a range of different countries. They've got the challenge also of the migrant crisis, which is putting pressure on political systems in Europe, in addition to the fact that there hasn't been very much structural reform put in place post-global financial crisis, which is something that was sorely needed in terms of getting the European economy to be more dynamic and to support growth. Overall, when you look at Europe and you compare where it is now to where it was in 2008, unfortunately, the European economy is no larger than it was in the early part of 2008. And so, although it has recovered from the depths of the global financial crisis and then the European financial crisis, the economy is no larger than it was. It's growing, but it's growing at a very modest rate, and they do have a lot of policy challenges to deal with.
Thanks very much for your time today, Paul.
No problem.